Welcome to Transform Now, a podcast focused on intelligent automation and brought to you by SS&C Blue Prism. On this program, we talk about how organizations globally are rethinking the way they operate, utilizing process orchestration and AI-enabled digital workers to free up humans to do the work that matters most. We also share insights and tips on how you can embrace this new way of working and unleash your full potential. Let's get into the show.
Hello, everyone. I'm Michael Marchuk. Welcome to the Transform Now podcast. Our guest on this episode is Andrew Einhorn, CEO of Levelfields.ai. Andrew has developed an AI platform that alerts to significant stock-related events such as earning reports, index additions, corporate actions, and such, which all could potentially lead to substantial price movements in the market. We're going to be chatting with Andrew about how leveraging AI in this way may impact the broader financial services marketplace that offers similar types of investment advice through traditional advisors. So welcome, Andrew.
Thanks for having me on the show, Michael.
I'm glad that you're here. So you haven't always been in the financial services space, but you ended up building a platform to analyze companies for trading and investing. Can you connect the dots for us?
Sure. So my background is in a lot of data processing. Started my career as an epidemiologist. So I was the one they would send out into the field and they'd say, hey, why is there mercury in the tuna fish? Go figure it out. And then we do a variety of analysis in the Gulf of Mexico and some mathematical models, and we determine it. And fast forward a little bit, started doing different types of consulting projects through a company called ICF International. And clients range from the FAA, Space Transportation Agency, to NASA, to government agencies, including the Defense Department, where we did a lot of risk analysis, event-driven analysis, and they started building technology systems. Fell in love with the process of building software, loved being able to shape my world and find solutions using a data-driven approach. And then started a company in 2008 or 2009, which I ran for 10 years and sold it to a private equity shop in 2019. That company was a software company, and it looked at events specifically for publicly traded companies. So my client base was like an ExxonMobil or Discover Financial, and there was always positive and negative events that were happening to those companies that were moving the share price up or down. The job of the software was to just find those events and flag them and send them to the PR people so they knew what was going on and can spin up their talking points. And so it was always a little bit in the back of my head, wondering maybe we're on the wrong side of this issue. We just saved them $1 billion in market cap by getting them the information quickly. What if we did the opposite as an investor and we're able to forecast these events? So once we sold the company, we knew what the deficiencies were in the previous model in terms of data analysis and big data processing and Boolean searches. And we went to just solve for those problems of how do you look at unstructured text, right? Just free form text, thinking about sentences, and pull out information while also accounting for things like tone and intention and snarkiness and all the cool acronyms that we use in social media these days. So we needed AI. And so we put an AI layer over a similar technology that we had built previously. And we looked at it from a different lens. And the lens is, how can we now look at events that are happening to companies and predict what's about to happen to the share price? And so we focused in on that. And I should say, my background, I've been investing personally since I was about 15 years old, and early stock investor and things like Netflix and Amazon and things like that. Of course, didn't hold it for 20 years, but that's a different conversation. And in any case, so we have these events that are happening all the time. And the challenge in the market is just trying to keep up with the amount of information, right? There's roughly 6,000 stocks just in the US exchanges, and the companies are releasing announcements all the time. There's events that are happening external to them all the time. For a typical investor, if you're on your own, there's zero chance that you can monitor the whole market. Zero. You have hedge funds out there that are multi-billion-dollar hedge funds that are hiring 200 to 1,000 people to monitor the market. So we thought that was unfair. We thought that the average self-directed investor was significantly disadvantaged in the market and that the game was sort of rigged. And we wanted to level the playing field, and hence the name of the company, Levelfields. And so we use AI to basically superpower an individual's ability to do research. So now they can set the AI to look for these types of events that move share prices, forecast what typical event movements are in the short and long term, and then conduct research just automatically. You no longer have to pour through all these documents just to find that one juicy nugget. The AI can do it for you.
Your AI platform that you've built looks through news or other events that you have, again, which could be anywhere in a Reddit subforum or whatnot, and leverages those to identify tradable events. So when you see larger financial services organizations who do have hundreds or thousands of people who do this on a daily basis or are very familiar with individual companies because of the way they staff their people to watch and monitor these things on their own, how do you see this type of technology disrupting the traditional methods of sort of financial analysis and decision making that are made not only on a personal level, but how this might transform the way these organizations do this type of work?
I think broadly, you look at it as we don't have to read everything ourselves anymore, right? So whether you're an analyst for large asset manager or just an individual investor, your typical process that you go through when you look at stocks are, let's do a stock screen. Let's find stocks that they have a dividend above 5%, positive earning, positive revenue growth, and that's your starting point. And you might refine it and say, you know what, I really like companies that don't have a price to earnings ratio any more than 40. I don't know anything about the materials space, so I'm only going to look at tech and maybe healthcare. Right. And now you have a list, and that's your kind of starting point for research, and everybody does the same thing. Point one is you have to then run that screen over and over again over the course of all the years that you're looking for these types of companies, because the companies are always changing in composition. Valuations are going up and down, revenue is changing. So we've automated that process. You never have to run that screen again. It's baked into an alert. That's your starting point. The second thing you would do with that list is then look at kind of recent announcements from the company, recent news about the company. Maybe you look at a 10K or 10Q, the quarterly financial report, and you're trying to gauge whether or not they're going to be successful. You read the guidance from the CEO. Is he guiding for higher growth or lower growth this year? There's a lot of work to be done for each individual equity. And if your list is more than 3 or 4 stocks, you're talking about tens of hours, dozens of hours, if not hundreds, to get through a long list. And so what we've done is that, you know what, we can see events that catalyze the share price because they are almost like a stimulant that happens with the company. And there's a few reasons for that. One is that when certain types of events occur, it gets enthusiasm for the investors. It also gets media attention. It gets analyst attention. So then the stock might get an upgrade. Then you might hear about it on CNBC after the analyst upgrades it and they start talking about it, and Kramer talking about it at night. And there's this kind of process of distribution of information that then occurs. But if you have the origin of all that at the event basis, you have it early and you can earn as this information diffuses across, the financial. And so by doing that and by being able to just focus on taking what would normally be the qualitative pieces and merging it with the quantitative analysis, you can fully automate the process of that research. You don't have to read every document. You just say, you know what, I want to make sure that this company doesn't have any DOJ investigations of antitrust. I can use that as a filter. I can look to see if the company is giving back to shareholders, because that is probably the biggest way to glean whether or not management has a bullish outlook on the company. If they don't, they're not going to give away cash. They're going to keep that cash, use it for spending purposes. So there's a lot of these things that they're not just events, but they're also markers for what the executives are thinking and what they're seeing. And realistically, as an investor outside the company, we don't really know what's going on inside a company. And anybody that says that they do, unless they work for the company, they're wrong. They're lying. The only thing we have are these sort of breadcrumbs that the companies leave us, right? They do earning quarterly, unless they're a foreign company. They do these sort of return of shareholder events, and they have these announcements of products and things like that. So those are the breadcrumbs we collect and analyze, and then we look at them in a way where we can forecast whether it's a bullish kind of breadcrumb that they left behind or a bearish one. And there's a variety of them in the market, and you can look at them individually or you could look at it collectively. And I can give you a very concrete way that this works. If you were to pull up a typical stock chart, you would see ups and downs and maybe some huge drops, huge increases. When you look at it, you have no idea why. that roller coaster is occurring, you then have to go into a news feed and look at that date. Oh, well, January 19th, this company sold off 30%. Let me look for news around January 19th. And maybe you find a news headline. And then you do the same for every single up and down on the chart. We put our events right on the chart. You just hover over it, just do this. It's about to go down to 30%, and it will say filed for bankruptcy. Okay. My research is done. So you're taking processes that took minutes or dozens of minutes for each individual data point, and we're just putting it right there on the platform, making it really easy to move through that qualitative analysis process. And if you do that across a large asset manager house that might have a couple hundred people doing this, or thousands of people at the big banks, you're looking at huge cost savings just in labor expenses alone.
So you mentioned a couple things. Going through that process of doing the analysis and the event gathering is one aspect of it. So I understand that there's an event that is happening or has happened based on whatever that is. You've identified the event. Is the correlation, I'm probably leading this, because is the correlation as perfect as saying that is always going to be bullish and that's always going to be bearish, or that's always going to cause a positive stock movement and that's always going to cause a negative stock movement?
For a lot of them, yes, it's almost a perfect correlation, with the exception that there are other events happening in the market that can affect that outcome. For example, you might have a company that does a terrible earnings report for that quarter just because, let's take like Adobe is a good example, right? So they had to do $1 billion breakup fee because they didn't buy Figma. Their quarter normally is about $4 for earnings per share. It was just over $1 because of that breakup fee. Now, that doesn't mean that that's not a good company long term. And if they announce at the same time a stock buyback of $25 billion, that buyback is a bullish indicator, but it's happening while the company is reporting something that's very negative, which is they just lost $1 billion because of this breakup fee. And so the stock may sell off that day if investors don't like that they have a dollar per share rather than $4 per share. So that's why I say a little bit of a caveat. If you could do it in isolation, it was only like a buyback announcement, most of the time it's a perfect correlation, with the exception of some of the fast growing tech companies that investors might look at and say, growth is over, because now instead of using their money to market and grow sales 40% or 60%, they're now doing buyback. What's up with this? I think this is now moving to a value company rather than a growth company. In that situation, which is really unique, it's probably the one caveat for that particular scenario. But for most of them, you're looking at 90-95% correlations. And in some cases, we actually intentionally put events on the platform to show people there is no correlation. For example, Tesla product launches have about a 50-50 chance of being up or down. And some of our users are like, why are you putting this, crap data on the platform? And it's like, so that you don't trade on the basis of it must be Tesla, it's only going to go up. And the options traders who use the system that are a little more sophisticated, they understand that, look, volatility is tradable no matter what. So I can bet up and down simultaneously and make money. But largely, I would say 3/4 of the events that are on there are 90-95% correlation to price movement.
So you did bring up something I want to cover, which I think is super important. So you mentioned, Tesla is coming up with it. It's a 50-50. You don't know if this is going to be a positive thing or negative, or viewed positively or viewed negatively by the market as a whole. But there's an implied volatility as part of that. And as you mentioned, some people will say, I believe there's a bias that any announcement by Tesla will be positive, or any announcement of this kind of activity would be negative, for example. So you mentioned large tech company who's been on a ballistic growth says that instead of growing at 10,000% a month, they're only growing at 9,000% a month. And they have so much money that they can't even find places to store it. Yet that's viewed as a negative event, right? Because of the dip in the trajectory type of thing. So when you look at those type of either the bias behind it or some of those external kind of viewpoints that maybe traders take into account with its volatility or whatnot, how does that factor into sort of the analysis? Because I would imagine I brought it back to that whole correlation, because it seems like there's a lot of moving parts. as part of this, so that I imagine the AI has a lot of things to take into account to say whether this is a positive or a negative type of event. Is that correct?
It does. Yeah. Ours, we were looking at, I would say there's two parts to that. One is on an aggregate scale for something like a buyback. It's just looking at all companies doing buybacks, largely bullish, and the system will show 75% win rate. Average move is 2.5% for one day. From there, though, you can filter a little bit pretty easily, just like you would filter for booking a flight. Say, all right, what about tech companies? And then the win might go down to 63%. And like, oh, that's interesting. What about large tech companies? Oh, it goes back up to 85% win rate because large tech companies are acceptably slowing, right? A Meta or a Google that does a buyback is still good news because it's still doing 11% growth. They've already slowed. But if you're mid cap, small cap tech, it changes. And so you can very quickly just do what used to take, again, like hours and hours through spreadsheet analysis and do it instantaneously on the platform. And we have ways where you can say, you know what, I know if I select something like a small biotech company that does have revenue, if they do a share buyback, that is a monstrous bullish signal because those are the companies that typically struggle to have money because they pay so much for R&D. And so we've seen those kind of events drive 20, 30, 40% in a day movements. And I think we've all had that same spot at one point or another where you turn on the TV in the morning and see this company's up 40% in the first 3 hours of trading. And you're like, why don't I ever hear about these? And this is what we're designing the system to do. And so you could hear them from the horse's mouth early instead of waiting for the analysts and the journalists to filter the information for you if they even cover it, which because of the size of news outlet these days being so small, most of the companies rarely see any press coverage. Very biased toward the Magnificent Seven or the FANG or whatever the top 100 companies of market cap size, because that's what gets the most clicks and drives the most ads, but not necessarily drives the most profits for investing in the market.
Getting back to the kind of the bias, overall bias, we've got the bias that we're seeing from just individuals who are looking at this, then the bias that could potentially come from either reading between the lines or maybe even commentary data that may not necessarily be as active or relevant. So when you have all this data that you're aggregating, do you find it that AI is challenged with being able to identify a positive sentiment or a negative sentiment because of the potential for this, I say, bad data?
A lot of our analytics are based on one day, not because it's the only thing you can do for trading, but because highest correlations can occur within 24 hours of the event. The further you go out from the event, the higher the likelihood there's a second event or just market sentiment changes that can influence the share price. And so that's we guard from bias that way by making it around the event. And over time, like we'll be able to make it smarter and taking into account multiple types of events simultaneously. And our goal right now is not that the AI can figure all of this out, because our AI is more like a massive speed reader, not necessarily like the processing of all the outcomes, but it's looking at 30,000 documents per minute, and it's identifying events that have been proven through AI processes to move the share price, you know?
So getting to that point, your platform is really designed for individual investors. And you've mentioned, we talk about these large banks who have hundreds of people or thousands of people who are working from an analysis perspective, doing something similar, applying their expertise and their knowledge behind the scenes to make the same kind or different kinds of analysis. Where do you see this type of platform or this type of AI moving towards within sort of a more commercial environment? Because I imagine if you're able to do this on the individual side, that these larger financial institutions who have $1 bazillion who are doing this on a regular basis, I would suspect that this would be something that either they're already working on or have already worked on to do something similar.
I think it's important to know there's different market participants and different groups, right? So we really don't discriminate what an individual investor looks like on our platform. You could be an individual investor who happens to work for a bank, and we have users who fit that mold. You could be an individual investor that used to be on Wall Street for 30 years and no longer have a Bloomberg terminal and don't want to spend $30,000 a year to use our system. And the goal for the different groups of market participants is a little different. You have long-term individual investors, short-term individual investors from the retail side. You have hedge funds that are the same, hedge funds that are poised for longer gain to have more tax efficient results. Those are typically the bigger hedge funds. And so they're not necessarily trying to trade event. They're just looking for good stock. And so their use case, along with most of the banks, is I'm trying to do research. I just need my research to take less time because I don't want to have 200 people doing this. Could I just have 50 or 10 on the research side of it? And a lot of times they are coming in with a investing thesis, right? They're looking for a certain type of stock, right? They invest in value stocks that have a high margin of safety, Benjamin Graham, Warren Buffett style. And if they find those stocks quicker, they get into it quicker, and that's all they're really looking to do. And they want to hold it for 10 years. We can identify those events and just make the process of assessment faster and easier, because I think there's a lot of wasted effort and frankly, a lot of news that's out there that is designed to get you to click on it, but has very little use for anybody. It's a ton of opinion in the market. They're just doing it on the basis of sentiment. I was watching GameStop again this morning, so scratching my head. As it pops 80% pre-market. In my view, like we want to have a little bit more of a level head in the marketplace, calm things down, have a little more data-driven approach, allow people to have an alternative thing that they can turn to rather than a headline that says, we like these stocks better than Amazon. We think they're going to be bigger than Amazon. Click here and pay me $100 and I'll tell you about what's in my magic ball. It's like, all right, there's enough of that in the market. Let's just get down to brass tacks. This is a financial event that's meaningful for the company. And if you know those, then you can invest on that basis because it means they're either going to make more money or lose more money, which is really what the market is all based on. I'm trying to simplify that process because I can imagine that there's better things to do with time rather than just constantly researching and looking for things. And I have enough friends who are in the kind of the wealth management space and they tell me, they're managing $250 million. And I said, how much time do you spend on your investments? And he's like, maybe 5-10 hours a quarter. What are you doing with the rest of your time? I asked. The clients are calling, so I'm calming them down. I'm explaining the market. We're looking at their financial projections. I'm onboarding new clients, trying to onboard new clients. I'm offboarding clients. I'm moving money around. I'm like, so really you're spending like 50 hours a year actually managing $250 million. Yeah, unfortunately, I just don't have time to do anything else. That by itself is a problem to me, right? That person who is supposed to be the safeguard for the money is not actually watching the money. They're watching the money come in and out, but they're not watching what's happening with these companies. Another use case for us, small wealth managers can use this system, get alerts very quickly, say, hey, this company filed for bankruptcy, or the DOJ just opened an investigation into this company, or there's a short seller report that is targeting the company for fraud. You might want to know about that quickly rather than by the end of the quarter after the company has gone down 90% in value. Things like that I think not only will help the industry, but also the consumer at the end of the day, right? Because if no one's watching over their money and their money disappears and the wealth manager's just saying, don't worry about it, just buy and hold, have a long-term view, all things will be fine.
You don't need AI for that, do you?
Yeah, you don't need AI to just sit in stock for 30 years, no. If you were to look at it and say, yeah, if you're in indexes, buy and hold works, but if you're in individual stocks, probably not.
So building on this kind of viewpoint of where the AI is positioned right now, specifically on your platform, but also within the countless of other financial organizations who are trying to build the same type of solution, whether it's to look at events or look at any kind of patterns on chart patterns and whatever they're looking at to manage all this stuff. Do you see that there's any risk associated with leveraging AI, or is this actually reducing the risk because you're able to see more?
Generally, I think it's reducing risk. It depends what kind of AI is applied and how you're using it. So if you're using AI like in a chat GPT sort of way and say it's just being fed tons of raw data and you're saying, go fetch this from the raw data, right? What was Q1 2024 earnings results for Apple? Is there any danger in having it retrieve that information as long as you can read what the actual report was? Because sometimes it's adjusted EPS, sometimes it's diluted EPS, sometimes it's core EPS, right? So as long as you know what to look for and that you're not totally reliant on the system, that's okay. In other cases, if you're using AI in predictive means in terms of reading technical analysis signals, matching that to other signals to try to assess market sentiment and then do projections off of that, and then you're running a multi-billion-dollar fund based on that quantitative algorithm, there's a high chance that something gets screwed up. And it might not take much. It might be the market goes out for 2 minutes and the algorithm gets thrown off and puts $1 billion into the wrong thing, thinking that the market was about to sell off. And you get something like a flash crash like we had in 87. And I know the folks at FINRA are really against any kind of automated trading because they're worried about something like that happening, where the system just takes over and there's a glitch and it spooks the whole market. And if you think about the way the market is designed, you have momentum algorithms and momentum traders. They'll follow whatever is happening. So if the AI is setting the stage by misreading the cues and pushing the market in one direction, all the momentum algorithms, all the momentum traders jump on them, and we see it go in the wrong direction. A very real example of this, which is simple, I have a wife who works in PR and she had worked for a pharmaceutical company in the past and told me of this glitch that occurred where they put out a press statement about a clinical trial of one of their drugs. And in the headline, part one of the headline said the drug failed to meet its goal, its stated endpoint. But the second part of the sentence said, but we figured out a better use case for it to solve another health problem. And so the algorithms jumped on the first half and all the stock was sold, and it was this like 7% drop in the share price. And then you saw this reversion that happened about 1 o'clock in the afternoon when some human probably checked the algorithm. It went right back up to where it was before, and they bought back the shares. And so now, if you're NPR, you actually have to be cognizant about how bots are going to be reading your words that you're putting out. And you have to be thinking almost like linguistic or prompt engineer, right? How is the system going to read my words? Not just how are other humans going to read my word?
Yeah. So as you look forward into the crystal ball of the future and you're seeing more and more AI being leveraged within the financial markets, what are you optimistic about?
I like the idea honestly, of smaller companies getting more credit. Having been an entrepreneur and having my own company, it's often the opposite of what we would root for in a movie. A movie, we root for the underdog. In financial market, it's always whoever the market leader is we root for. But I don't necessarily think that's fair or even right. You have a lot of companies that are crushing it, doing really well, and they're growing 30, 40%, and they're managing capital far more effectively in an early stage than some of the market leaders did at that stage. So I like the idea of having more equitable coverage for a lot of these companies that I think struggle to get some attention and they're pretty good stocks and good investments. And one of the reasons I love doing what we do is I get to see a front row seat to the economy, where I get to see all these reports and all these different events and all these different industries I never heard of, analyzing companies I didn't even know were publicly traded stock. Could be a daycare stock, or there's a breakfast place called First Watch that I love. I think they have the best breakfast out there. I didn't know it was a stock. It is a sweet green kava. There's just a lot you discover. And once you're able to do that, you realize, oh, wow, there's good value that's hidden in the market. And it's been hidden for a long time because of the bias of the media to cover whatever Elon Musk says or is doing 20 times a day. And whatever the latest Apple iPhone tweak gets the most coverage. But there's a lot of other cool companies that are out there, companies that are doing interesting things with pet meds and crazy new things with generative AI. So I like that part. And I'm more optimistic that an average investor now using these types of new tools like a level field, which is only a couple $100 a year, they can improve their performance significantly just by being able to see more of the market and not have to be so reliant on the news, which is often influenced, if not intentionally influenced, by some of the larger market participants.
But again, looking at the broader viewpoint of it, AI, it sounds like has the capability of either being manipulated more easily, but also may have the ability to uncover that type of manipulation in different ways that maybe people would overlook just because of the sheer amount of volume of data that it took an analyst a 50-page report to describe. That potentially there's a plus and a minus to both of it.
That's right. And I think there's different data points you can program with. Another quick example of some of the manipulation I've seen, small companies will also issue press releases saying they're doing stock buyback, that they've authorized a $200 million stock buyback. But if you look at the cash on hand, like the cash that's actually in their bank account, it might be $2 million. So you put two and two together and going, how are you going to pay for that $200 million buyback with your $2 million that you have in cash?
It's a long-term plan, right?
Right. And that's what they would say, but there's no way that's going to happen. Then they're just trying to get on the map. They're trying to get somebody to notice them in the Robinhood platform or whatever terminal so that the news pops up and someone says, oh, check that out.
Yep. That makes sense. I think there's a lot of opportunity here, and I really appreciate you exposing some of the things that are going on now within the financial services industry related to investing, because I think things are changing very rapidly, and that understanding how AI can both expose but also be tainted a bit is important for people to understand, so that when they look at the news that is coming out or look at activities as they're trying to either individually do this or, for instance, mentioned wealth managers who are trying to support the funds that are being entrusted to them, that there are now tools to be able to do that in a more effective way. So thank you so much for talking with us today about this. I think it's really important that people understand that AI can be used in a bunch of different ways. And based on what you're doing in the financial services world, I think is really important for people to understand. So thank you so much, Robert, for joining us today.
No, thank you. I appreciate the time. And if you haven't yet written it down, write down Levelfields.ai and go to the website, sign up. You can use podcast 23 promo code for a discount.
Thank you for listening to Transform Now, the podcast from SS&C Blue Prism. You can find all of our episodes on your favorite podcast channel, as well as YouTube. To stay on top of the hottest topics in the world of intelligent automation, subscribe now. The future of work is here.